Well, hello and a very warm welcome to this webinar, Commercial Real Estate, How Concerned Should Debt Investors Be? Brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator for today's session. Now, of course, commercial real estate continues to feature in the news almost daily with gloomy headlines around stressed valuations, capital market access, refinancing risk, bank and investor exposure, even financial stability risk. But is this really justified in Europe? To take us through these topics, I'm delighted to be joined today by analysts from three of Scope's ratings franchises. So let me introduce you to Philippe Vache from Scope's corporates team, Matthias Pleissner from Covered Bonds, and Christian van Beek from the banking team. In a moment, they'll each deliver some brief top line thoughts, and then we'll move to a Q&A. And we'd also be very happy to take your questions. So please do type these into the questions box on the platform and we'll pick them up at the end. Although please note that we will not be able to discuss in detail individual banks or companies on today's session. And if for any reason we're not able to answer your questions today, we will circle back to you one-on-one after the session. Today's presentation will be available for download at the end of the session, and I'll explain how to do that later. So that's it from me, gentlemen. Great to see you. Let's get started. Philippe, I believe you're going to kick us off.
I will do indeed. Thanks, Keith, for the introduction and also a warm welcome from my side. So you have seen that slide probably. So this is the three of us who will guide you through today's webinar. And I will actually deal with the commercial real estate corporates. And indeed, 2023 was a tough year for real estate. So the drastically changed interest rate environment hit the sector on several fronts. So first of all, values came under pressure as cap rates widened. Second, interest cover fell as a result of sharply higher borrowing costs. Third, the industry faced a liquidity crunch in both the investment and capital markets. And fourth, tenant and investor demand began to shift away from office and non-ESG compliant secondary assets. So, which in itself led also to higher vacancy rates and lower rental growth expectations. And in addition to that, so on top of all of that, we have the prevailing economic and geopolitical uncertainties, which have dampened growth and led to rising tenant defaults. A direct transition of these pressure points occurred in the Nordics because of the company's short-term and floating funding structure, and for developers or home builders because of drying up of liquidity due to plummeting demand, which in itself also led to an increased number of defaults. But the question is, have property companies digested most of the pain already? We believe that the stabilization of borrowing costs, you can see this on the top left chart, lower inflation expectations, and the flattening of risk-free yields will reduce upwards pressure on cap rates. So if we look at the spread between the cap rates, you see at the bottom chart, and the risk-free returns, these spreads are actually now at heights that have not been seen since the monetary easing began in 2012. So there is an adequate spread actually to risk-free yields to reflect the illiquidity of the property class or the real estate asset class. In addition to that, what we will see is there's an increased motivation for sellers to release capital through asset sales to manage either refinancing risk or to reduce pressure on leverage, which will support a slow recovery in investment markets alike. That being said, credit quality will remain under pressure for a couple of reasons. First of all, borrowing costs will remain at least double, if not triple, what they were before the monetary tightening. And this will slowly eat into the corporate cash flow. So interest coverage ratios will fall. And we will also face low rental growth expectations, particularly for office and retail properties, making it difficult to offset higher financing costs in the short and medium term. Second, we will see a further correction in property values, so it's not over yet. The reopening of investment markets with motivated, and just say it will determine the final correction in values. And you can see on the top right chart where we took a sample actually of the share price versus net asset value per share for some listed REITs we have in our peer group, that the market expects that there is some particularly strong downwards pressure. This seems to be a bit exaggerated, but still what we believe is that, especially in the residential as well as in the office property segment, we will see some further fair value declines. And what we will also see is a higher differentiation of credit qualities along property types and qualities, because we see a weakness in office for secondary and non-ESG compliant assets, and also along the cost of capital. So the widening spreads we observed between investment grade and non-investment grade rated issuers are there to stay. And this all comes at a time when around 120 billion of capital market debt are due to be refinanced in the 3 years to 2026. So this is almost actually the amount that has been refinanced in the last 6 years. And as a result of that, we'll see more covenant breaches, distressed debt exchanges, and also defaults. Especially at risk are developers, where there's no material recovery of demand in sight, small and mid-sized players with a bulky debt structure. Just imagine there have been a few players that tapped the capital market on a senior unsecured basis because it was very, very cheap. So they issued benchmark bonds that now account for 1/3 or even 50% of their overall liabilities. And these need to be refinanced then either this year, next year, or the year thereafter. So it will be more difficult for them to refinance this kind of debt. And of course, also we will see more pressure on companies that entered this period of higher interest rates with a significant debt burden, or companies which relied actually on the low interest rates or funding costs to generate positive cash flow. But there won't be a systemic meltdown because capital markets will slowly reopen. We see that capital market issuance activity is picking up since the third quarter in 2023. It is reaching its highest level since the monetary tightening in the first quarter of this year, and also transaction volumes show some sign of recovery in 2024. And this increased liquidity will help at least the stronger players in the sector to deal with all of these pressure points. That being said, there are also a couple of other slides I will touch base on then later on in the Q&A session, and I will hand over to my colleague, Matthias.
Thank you, Philip. What you're saying for corporates is certainly also true for other markets exposed to commercial real estate, for instance, CRE lending activity of banks. And as we all read in media, with a focus on some German lenders, including issues of Pfandbrief in particular. I would like to give you a short introduction of the German CRE landscape, which is based here on cover pool data from German Pfandbrief banks, more or less as a proxy for the overall market. What I try to give is some insight whether banks have changed their risk appetite during the last decade, which was characterized clearly by very low yields, strong competition, and increasing demand into commercial real estate. As the covered bond analyst, I would also like to strike a blow for German Pfandbriefe by quickly sharing some relevant details on their robustness. And after I'm done, I would like to hand over to you, Christian, to provide some insights to the German banking system and potentially even to answer the question whether banks can weather the storm. First of all, we do not necessarily see any kind of massive shift or change in CRE loan underwriting during the decade left behind. So if we compare the share of commercial real estate exposure to the total mortgage portfolio, it even appears that banks even lowered their CRE share from around 47% back in 2014 to now 37%. When looking at property types, what we can see obviously is that over the last 10 years, retail exposure has shrunk. Opposed to office, retail properties have kind of already had their moments, fueled by new trading channels from online penetration. And finally, when this segment started to adopt the new situation, the pandemic turned the market upside down again. So it appears just reasonable that banks have reduced their retail exposure during the last 10 years. While most of the other property types take rather a niche, office accounts for around 50% today, up from around 40% 10 years ago. And that's quite a lot, taking into account that some effects following the pandemic have also had some abrupt and potentially longer-term effect on office properties. What we're observing today for office is what shopping centers and retail experienced over the last decade, a correction of values to lower and potentially even more sustainable levels. In particular, office in the US has also observed some quite substantial depreciation. Looking into the cover pools of German Pfandbrief banks, their exposure, however, appears to be limited. In total, US exposure account for 8%. And yes, I mean, that's actually a doubling up from 4% 10 years ago. But more than half of the total CRE exposure is still exposed to Germany, followed by France, the Netherlands, Poland, and some downsized exposure to the UK. So to wrap up this slide, CRE is certainly a hot and a very relevant topic. German banks do face risks, in particular if the situation in some segments deteriorate. But what we cannot see is an overly aggressive behavior of the bank's underwriting during the last decade that could indicate a systemic crisis based on unhealthy or overly bullish risk appetite. If we focus a bit more on German Pfandbriefe, in particular if secured by commercial real estate, we have to talk also about the Beleihungswert. For those of you that have not heard about this concept, the Beleihungswert itself is a conservative approach to determine a property value, which shall be independent of cyclical volatility. The Beleihungswert restrict Pfandbrief issuers to issue covered bonds against a collateral that exceeds loan-to-lending value thresholds of 60%. And why is this important? I mean, at least it's quite interesting because banks do report both lending values and market values for German covered bonds or the respective collateral. Okay, what we can see here is that the Beleihungswert itself stands quite stable at 55%. Which corresponds to a loan to market value of 35% only. The distance between the two was increasing significantly during the last 10 years, and this indicates, of course, some more aggressive valuation in market value. That's good for the covered bonds because this also increases the distance. Again, I mean, a covered bond on average in Germany is exposed to a loan to value of 35%, but may also indicate that market values are elevated still compared to the sustainable lending value. We see some correction during the last year, but there might be a bit more way to go. What we also can see here on the chart or on the slide is that Pfandbrief investors are well off, taking into consideration the buffer I just mentioned, but also the very strong over-collateralization currently on average at 37%. With that picture, let me hand over to you, Christian, hopefully confirming some of the findings I shared already.
Thank you, Matthias. Yeah, I do want to draw your attention a bit to the EBA data. The week before last week, we had the publication of the EBA risk dashboard data as of end of year 2023, and there's a couple of takeaways which I want to explain a bit more. Here on the left side, I represent the total commercial real estate loans by country. We show here the countries with exposures of more than 100 billion, and the rest of the EU is in the light blue area. And here it is interesting data how the commercial real estate exposures evolved in the last 3 years. And when it is important to understand that if you look at EBA data, and in particular German exposures, you need to understand that the number of reporting banks to the EBA is for Germany far below other markets, which means that the exposure to commercial real estate looks in this chart far lower than it is in real terms, because savings banks and the local cooperative primary banks are not reporting to data, and we don't have the data in here. But for us here to understand a bit more about the German and European commercial real estate market, this data is just good enough. And you can see here how France and Germany are exposed to the commercial real estate. And on the right side, we wanted to learn more about the non-performing part of this commercial real estate exposures. And there we can see that the story of non-performing loans and the CRE sector is from country to country very different. So you can see that historically it has been very low in Germany, and for example, Italy has reduced the NPL exposure drastically in the last 3 years. We also see a reduction in the Netherlands. We see a slight increase in France, and I mean, and this is a very takeaway of this slide here, we see a strong increase in Germany when it comes to NPL. So, but still, the data of the EBA risk dashboard seems to be a bit exaggerated, because I mean, if we look now, and this is a number which you have seen on the previous slide, the 85 billion of CRE loans in Germany should be about 500 billion when including all banks in Germany. So the 5% NPL ratio seemed to be a bit too high when compared to the total amount. But I think this yellow line here is very clear for us how NPL evolved in Germany in the last, let's say, 18 months. So there's a strong increase here. So this is a very important takeaway for us, although it is maybe exaggerated at that time. And I mean, for me, the most important takeaway from the risk board data is within this chart here in the middle, the loan loss coverage. So here you can see this is just the same data which you have seen on the previous chart, that the NPL in the commercial real estate exposure has increased to 13.6% by the end of 2023, and this is that means that it has almost doubled within the 12 months here in 2023. And what is very important here, when you look at the loan loss coverage here, which is also increasing, but not as much as non-performing loans, and that means that the NPL coverage comes down quite significantly here over the course in 2023. So the question now, how deep is the problem, or how concerned should we be? And this is the most important line here in this little slide. It's a green line, because it tells us the uncovered commercial real estate NPL. So this part here relative to CET1 capital, and this is with 5% at this moment, still very manageable. So it has been increasing for 2023. This is what we now know, that in this time period we have this strong increase, but it is still on a manageable level when compared to CET1 capital. The other thing is to explain, if we would include any other exposure of German banks, the uncovered NPL would amount to 11.4% of CET1, which is a still satisfactory level, and it would be still 200 basis points below the EU average. So, in terms of, or relative to CET1 capital, it seems very digestible what we have seen here, although the dynamics are very concerning. But I also want to give you the perspective what these kind of credit risk in the CRE segment means in terms of profitability. And here you can see how German banks have catched up in profitability in the last years. And we consider this very much to be a sustainable development, because German banks have used the time of the ultra-low interest environment to get their structures in order to reduce cost, to consolidate in the market. This is particularly true for savings banks and cooperative banks, which are not included in this data set here. But anyway, we see that profitability has improved here substantially in the last 2 years. And here the yellow line tells us how the credit losses compare to the equity, and when compared to the return on equity and the credit losses compared to equity. This is the data which comes directly out of the EBA, so they chose to create this kind of KPI, but still we find it very interesting that the 2% of equity is still very far below the loss absorption capacity out of the profitability of the banks. So we would give you the takeaway from the EBA data here that relatively to capital and relatively to the performance, the commercial real estate issue for German banks is very much manageable at this stage. But given that we see this high dynamic in 2023, we think that is clearly an issue to watch for 2024 as well, and I'll give you a bit more of an idea later. But we are looking here at very aggregated financials, so we want to give you a bit more of a flavor what it means for single banks. And here we use the EBA data from the transparency exercise. Unfortunately, the latest available data is of end of June 2023. But given that the dynamic started with the beginning of 2023, we think that this is still very useful data. And here you can see we have sorted the German specialized lenders by the level of the NPL in the commercial real estate exposure, and you can see that there has been a strong increase for a couple of banks. So it's not a consistent picture across all German specialized commercial real estate lenders, but you can see here that for some banks we see a strong increase in the NPL ratios. So very important to understand that. Yeah, on the left side of this chart, you see the banks which are much more exposed to the crisis. And this also gives us an idea where this crisis comes from. If you remember the chart for the European banks, so it seemed to be very much a German issue here in terms of commercial real estate. And if you now look here on the left part of these banks, you also get an understanding where this problem comes from. And this is in particular the US office market, because these banks with these strong increases here are in particular exposed to these sectors. But the story I told you with regard to profitability and how banks have improved their resilience against such a commercial real estate crisis. This is also what you can take from this picture here. We have the same sorting of the lenders, and here you can still see that the interest rate environment with the interest rate hikes has not only increased the issue on the commercial real estate market, but it has also helped the P&Ls of the banks in terms of revenue generation. And here you can see that the profitability for the banks, which even have this strong increase on NPLs in commercial real estate, were able to even improve the profitability in this market. And this is also a graph which for us is very useful in terms of narrowing down the number of issuers which are very much affected by this current environment. And I mean, this is what you can take out of this graph. And I mean, what are the key takeaways out of this information? We see that banks are decreasing their exposure to distressed real estate segments. This is what we clearly see, especially for the issues here on the screen. We see also that there is a funding risk for these issues here, and you see here a lot of issues which are included into the German SFG, the Savings Banks Financial Group in Germany, like the Landesbanks or also DEKA, and also the Central Bank of the Cooperative Banking Group, DZ Bank. And this gives us also some comfort when it comes to funding, because these banks have a very strong funding source out of their group, so that in terms of narrowing it down to the issuers which are in particular exposed to the crisis would be more the independent ones here in this list. And maybe one last remark, and a bit forward-looking into 2024, I would say, have we seen the worst already? And this is now when it comes to the question of the US commercial real estate market and the office, I would say yes. I mean, we see that, we foresee that the loan loss provisioning for these segments is unlikely to increase for 2024, and so it means that we foresee a very digestible amount of loan losses for the next year. But if this real estate crisis would spill over to any other segments, like in Europe, in Germany, in other type of real estate, then we need to review that statement. But again, this dashboard data, which we had a view on earlier, will give us a good impression of what to watch and how this evolves. But for the time being, we would say that there is no systemic risk inside coming out of this issue. Yeah, and this is so much for the time being, Keith. What's on my statement?
Good, thank you very much, Christian, and also Matthias and Philippe for those excellent comments. I've got a lot of questions, and they're sort of slightly all over the shop. So if you don't mind, we'll jump around a little bit and try and get some of the questions answered. We do have a question, which I thought we would, on Christian, which of the monoline banks is going to go bust first, but we're not going to answer that one. Because well, we're going to steer clear of that one, I'm afraid, to our questioner. There's a question, Philippe, about the observed trend in vacancy rates in office exposure, and the question is, are the CRE companies still able to adjust prices upward without incurring requirements of increased standards for demanding rent levels? I'm not sure if you're able to answer that, but do you want to maybe take a general shot at stab at an answer on vacancy rates?
So generally what we observe in the market is that for some issuers, currently ERVs are below the current rents. It means that the estimated rental value for office space is below actually the rent they collect from their existing tenants. The good thing is, of course, that rental lease contracts in the office sector are between 3, 5 or 10 years long. So as long as these tenants remain in the property, the landlords benefit mostly from the CPI-linked leases there. So there is still, so to say, some upwards trend in rents. So where it becomes really, or when it really hits actually the earnings capacity of these companies is when they need to re-let vacant space. And what we clearly can see there is that, of course, space that is rather brand new, that is ESG compliant, there aren't any, let's say, significant issues. So still rent levels are increasing, even if tenants require less space, they are willing to pay higher rents if, so to say, the space matches their expectations. On the other hand, we see more and more, let's say, even stranded space. Yeah, so it's not a stranded asset yet, but we'll see that there is some space that is not ESG compliant and which is maybe also in secondary locations that cannot be re-let at all. And then the question is really if it does make sense to invest into this space, and whether then the return on these investments will be high enough actually to cover the associated costs. And this is actually a big question going forward, because also regulatory requirements will increase. So the EU set the goal to become carbon neutral by 2050, and there is a lot of investment needed. And we doubt that this will be feasible at the current, let's say, level of market values, because then you need to have an incentive also as a potential investor to really execute these investments to ensure that there is a proper return. But for now, what we can see is vacancy rates increase in these secondary locations or for secondary quality properties, and thus, we'll have there a downturn.
Okay, thanks. And just jumping across, Christian, there's I guess a quite data-specific question to the comments you were making on the slide about CRE NPL coverage, and which is the following: how do you explain a low CRE NPL coverage, 23.6% in 2023, in the case of Germany, as per EBA report, given the actual bid-ask price gap, especially in Germany? Is that something you want to perhaps think about and revert later, or can you provide some insight now?
I can try to answer that question. I mean, this is a difficult question to answer. You have to look at a lot of parameters to get an understanding for this. But most important here is that we are looking at a Pfandbrief market, a covered bond issuers market, and this here is important. What Matthias explained us earlier, that we have underwriting standards with very low LTVs. In this lending, so I think that there is a lot of buffer which is coming from that side, especially when compared to the other countries. So I think the gap can, for some extent, explained for that reason. Yeah.
Matthias, do you just want to just recap what you were saying about the buffer and the extent to which you feel comfortable about the position that the Pfandbrief banks are in at the moment?
Sure. I mean, this buffer itself, that's a buffer which comes from the distance between the Beleihungswert, the lending value, and the market value. And this is something which in particular is applicable for Pfandbriefe, right? Because this is basically determining the issuance volume of a Pfandbrief program based on its collateral. At the same time, this buffer is not necessarily something which is relevant for German Pfandbrief banks when it comes, for instance, to the capital requirement calculation, right? Also here, they rely typically on market values, not on the lending values. And also here, certain volatility from market values might come into the game. By the way, this is also something which regulators don't like, and they have just recently, well, not too recently, but they have introduced also proposal on changes to the CRR, where they have introduced a new kind of value, the property value, which should be used instead of market value when it comes to capital requirement calculations. And that's something which obviously might be a change on the horizon then in the future. But market values also are applicable then to Pfandbriefbank when it comes to their underwriting. So when it comes to the loan documentation, the banks, of course, introduce covenants like default covenants referring to loan to values, which could, in case of volatility towards the market value, also cause technical defaults, which then in accordance will also drive, well, non-performing loans. Not sure whether this is actually what we are seeing currently with a significantly increased non-performing loans, in particular for German monoliners and CRE lenders, but certainly something which is going to drive non-performing loans as well, just from a technical perspective.
Yeah. Okay, just perhaps a related question, Philippe. We talked a lot about Pfandbrief issuance and bank exposures. you've written in the past, and I know it's something you follow, which is refinancing risk amongst the real estate companies. How do you see the bank appetite for supporting the real estate, CRE developers and related companies? And I guess we have seen, as you mentioned, the return of senior unsecured bond issuance as well. Do you see a change in the interplay between bank lenders and bond investors in taking up the refinancing risk or refinancing appetite?
So maybe I can use one of my backup slides to provide a bit more detail around that. So actually refinancing risk, what you can see here on the left-hand side in the chart is the link between the loan to value of specific issuers in our peer group and the debt that matures in the next 3 years. You can see that especially at risk are the companies that are on the top right side of the chart. So companies with a high loan to value and a lot of debt to be refinanced. So this is actually as a consequence also of the capital market refinancing that is needed. And your question is about whether bank lenders are willing to step in to close the funding gap. You can see there is some uptick in bond issuance activity, but it's not really closing the gap actually to what is required. I believe that banks are not willing to extend their loan books, so they will keep their loan books stable, but of course support their existing clients. If these clients, and this is also what we see, manage their balance sheets in a proper fashion, meaning actively reducing leverage, actively reducing the debt burden by selling assets. Yeah, and as a consequence, banks are also willing to accept, for example, lower interest coverage ratios. So just quote unquote, yeah, 1.3 is the new 3 times in interest coverage, or let's say 1.5. So banks are willing also to accept, let's say, a low interest coverage as a consequence of these heightened borrowing costs. But banks will not step in and close the funding gap. So it's actually the obligation of the issuers to either dispose of assets to reduce their leverage, or they really have an issue and they might tap the grey capital markets, so other sources of funding, which are super expensive, and maybe this is not even bearable, because if your portfolio yields, I don't know, at a 5 to 6%, and you have a leverage of 60%, if your borrowing costs rise to 10, 11, 12%, this is not sustainable, and as a consequence, you will file for bankruptcy.
Okay, actually, there's a couple of questions. So I'm going to stay with you for the moment, Philippe. There's a question about the real estate risk premium, which it says has mostly returned to the historic 10-year levels, but is that historical level consistent with the obsolescence premium, which is not priced in the past?
So what I've shown here in that chart is actually the spread between the prime yields and the risk-free returns. And to just be very clear on that, of course, if we look at the spread between, let's say, not the prime yields, but the secondary yields, this premium will come into play. So we see a much stronger increase in cap rates for properties that might become stranded assets, yeah, that might not attract any further tenant demand or investor demand. So of course, if we compare that like for like, maybe for these kind of assets, cap rates have not risen or have not rose to an extent that is actually needed.
All right, and there's one, I guess I can put to either you, Matthias, or Christian. Question, I'm thinking my German here. The larger the gap between OMV and Beleihungswert increases in non-family funding, which is becoming more expensive. How far will that be denting profitability for these lenders?
Well, I recap lots of Pfandbrief lenders to talk about the huge disadvantage they do have with the whole Beleihungswert concept, and exactly the fact that their unsecured funding is significantly higher compared to peers, to competitors. I mean, to answer the question, certainly this also depends on the respective unsecured costs of individual lenders. It's going to harm, but at the same time, I mean, taking into consideration that what we have discussed earlier, that property values are rather shrinking, market values, OMVs, right? This gap is most likely rather declining. That's something we already see compared to last year. There's some lower distance between the two, and accordingly also some lower gap between unsecured and secured funding. Yeah, but at the same time, I mean, this difference exists. While I also understand that this is a positive element of the Pfandbrief opposed to some other covered bond programs, which potentially nowadays investors might even like, you know, if opposed to other programs. Christian, do you have anything to add?
Yeah, I mean, I referred to it earlier. I mean, when we look at the list of banks, we see a lot of banks which are included in the savings banks financial group or in the cooperative financial group in Germany, and it means that savings banks or local primary cooperative banks can buy senior unsecured debt of these lenders with a 0% risk-weighted assets. Or without a capital consumption, and that makes it for these banks, or this means for these banks a very strong level of stability for the refinancing in the next months and quarters to come. And that may be different for the independent specialized lenders. So this is clearly something which I would say is something to watch for, in particular these banks.
Indeed. Philippe, I guess there's a short question with a potentially big answer, but there's a question about your take on the Nordic CRE sector. Do you want to just provide some top-level thoughts briefly on the Nordic sector?
And again, maybe I make use of the say of the backup. So actually, with regards to the Nordics, what we can see that the transition actually of the changed environment was very quick because of actually the almost short-term and floating funding structure. So what you can see here as a downward pressure on interest cover is mostly linked to Nordic companies we have in our coverage. So a lot of pressure has been digested there. The main issue is, okay, there is some upside potential if interest rates fall and actually their bet on short-term funding and floating rates actually pays off. So then interest cover ratios could improve. But there's still some downside risk, especially if you look at the headroom some Nordic companies have to their covenants of their senior unsecured debt facilities if it comes to the ICR. And this is where we see some pressure in this year. And it could be, let's just say, some will fail actually to meet all of their obligations introduced by the senior unsecured funding they have entered into.
Yeah. Okay. Look, we're going to be moving towards the end of our session shortly, so I've got some questions left. But if you do have questions to ask, please put them in if you could in the next couple of minutes. That would be helpful. So there's just one just came in, which I guess let me put it to you, Christian. How do you see the risk of default of local real estate developers financed by regional banks in Germany, but also in France?
Ooh.
Do you want to revert on that one later?
Maybe so. Maybe yes. Yeah. So we see a couple of developers defaulting these days, but the number is still low. So when I see the list provisioning of regional banks, which means savings banks and primary banks, I would say there is nothing which is worrying too much these days. I mean, at the end, in the last quarter of 2023, we had this this default in Austria with the Signa Group, and there were also a lot of regional banks involved here with quite substantial amounts. And we have seen that in the current environment with very much increasing net interest margins and good progress in net interest income for these banks, this was very digestible. And I don't see that kind of defaults increasing very much in the regions of Germany. So yes, there are defaults, and we can see these, but for the regional banks, we don't see any bank at risk given the environment in terms of profitability and also capital.
Right, that makes sense. Thank you. I'm just going to ask each of you just to maybe in a second for some perhaps sort of general wrap-up questions. So you've made, I think your perspectives were very clear through your presentations, and the answers to questions to date. But perhaps I'll ask you to summarise your thoughts now from each of your perspectives. How comfortable, how concerned are you about the situation in Europe with regard to commercial real estate, and are there things on the horizon that you're keeping your eye on? I mean, and feel free just to recap what you've already said, but yeah, I mean, how do you see the situation today and going forward? Are you equally comfortable or not? And what are the potential issues out there that are concerning? Matthias, do you want to kick off? I mean, you're quite clear. So are you giving the all clear from a rating agency perspective?
Well, I mean, first of all, as a covered bond analyst, I'm quite relaxed due to all the buffers and layers of protection a Pfandbrief basically benefits from. I'm also relatively relaxed from the historical portfolio distribution we have seen for Pfandbrief banks, which does not indicate any kind of additional or very risk-taken selection of assets within the asset books of the respective banks. At the same time, what we have not done in regards to this analysis, we didn't dive into individual lenders. So certainly, if we would do the same, we will see outliers. We will see outliers in terms of risk taken over the period, and we will see also outliers in regards to the hot areas currently at debate, US exposure, office in general. So from that perspective, risk is out there, as said, not systemically, and I guess this is important. And again, from a covered bond perspective, quite relaxed.
Yeah, Christian, is that your the general thrust of your thoughts will be similar?
Yes. So I would say what to focus on. I mean, this is on the slide 14. I mean, this is a clear picture, and the problem with this data is it's a bit backward looking. So, but I think it's still worth to watch, because we see it a certain dynamic, and I think the evolution of the NPL ratio in this commercial real estate, and also the widening the gap when it comes to uncovered NPL, and what it means in terms of loan loss provisioning in comparison to the P&L. The P&Ls of the German banks will normalize a bit because of the interest betas, which are still at a low level. So we also take some comfort out of this for 2024. But the dynamics here in these three charts we have chosen here is in particular to watch. And on the later slides, I have shown names which may be more exposed with regard to the current crisis, and I think this is a clear indicator. So there are the names to watch. There are the names in terms of are these involved in or included in greater financial groups, or are they independent in terms of raising funding? And so these are the key points to watch in the future, and this is what we do these days. And if we said that this is very much digestible for the time being, we think that there's not a high risk of bad news flowing in the next months or quarters. But I think we should take these indicators very seriously, and then see in terms of single names who would be then affected most by these dynamics.
Yeah. Makes sense. Thank you. And Philip, can you give your perspectives? I guess, look, if you could perhaps factor in, one of the things we haven't talked about really is whether asset sales are a realistic option for companies that running out of road in terms of their financing or access to finance. But could you give us a broad perspective on the sector going forward?
For sure. So actually there are two main questions. The first one is actually how fast can property companies grow their rental cash flow to cope with the increased borrowing costs. Of course, there are some sectors that are, let's say, in the favorable position if we look at the residential sector, but also if we look at logistics and light industrial. So there is still some strong demand for retail and for office. Maybe with this slack demand, rental growth perspectives are not that strong. That means, as a consequence, that there will be additional pressure going forward, especially on interest coverage ratios. One mitigating factor is, of course, also that development volumes plunge to a very low level. So there is not much of new space actually that will come into the market. So this will support to some extent rental levels. So this is one of the questions. So how easy, so to say, companies can cope with these increased financing costs. And some will fall off the cliff. As I said, we will see some covenant breaches. And the second one is also dealing with your question, whether companies will be able to sell assets in the current market environment. As I said, there will be much more motivated and distressed sellers actually that now see, okay, the pressure is intensifying and then need to go to the market. And they will have to accept steep discounts actually on the properties that are up for sale, not only because they are in a weak position, but also they have to consider actually the financing costs on the acquirer's side. And as such, this will also have an impact, of course, on market values, as I highlighted. So loan-to-values will remain under pressure, as well as interest coverage ratios. And only the large, well-diversified and strong companies with low leverage actually will deal with this pressure and will not have that much of hard feelings going forward. So it's rather really the low end of the credit quality scale, so high yield issuers that will face continued severe stress.
Yeah, that makes sense. So I have no more questions. So gentlemen, I suggest we close the session here. So thank you all so much for your presentations and great answers to questions. And thank you to our viewers for staying till the bitter end, although it was actually a fascinating session, so I'm sure you enjoyed it. For those of you who actually wanted to download the presentation, if you go to the bottom of the screen on the right-hand side and click on apps, and then what should come up is handouts, and you click on handouts, and yes, there it is. There's a download button for the presentation, and so please do that now. This session is going to be broadcast or rebroadcast on I think quite soon, actually in a few minutes, on LinkedIn. So if you enjoyed it so much you wanted to watch it again, you'll be able to do that, but feel free to pass it on to colleagues and to clients as appropriate. And the last thing for me is that we do publish research and commentary on commercial real estate, both from a corporate side, from the covered bonds and banking side, and indeed from structured finance. And so these are all made available on the Scope Ratings website. So do keep a lookout for that. And so that's it for now. Thanks so much again. We'll see you next time. And in the meantime, wishing you all a very successful rest of the day. It's goodbye from us.
Thank you. Bye-bye.
Thanks.
Thank you, Keith.
Bye-bye.